I do want you all to know that we have this content. We also, again, are going to have happy hour when all the content is over. And we had a quick little fire drill yesterday. And thank you, Hannah, on our team. There will be TVs down there for the basketball game. We had to make sure of that. Just in case you're worried. Our next guest is the 9th CEO of the nation's largest public pension fund, Calpers CEO, Marcie Frost. So, Marcie, as I said, Calpers is the largest public pension fund in the U.S., $440 billion as of the last fiscal year. You also run one of the country's largest kind of advocates, you could say, public advocates, for using ESG as a lens for investing. So, outside the acronym, what does ESG actually mean to you in Calpers?
Yeah, I really appreciate that question. I'm sure you're all aware of this ESG, anti-ESG debate that's going on, primarily, frankly, here in the United States. But for us, ESG really has not changed that much over the last 15 years. It's a way of looking at our assets. It's a way of looking at the investment decisions that we're making today to make sure that they can stand up to issues around climate, extreme weather, whatever you want to call it, human capital issues and governance issues with boards. And so we have been a long-standing advocate on getting regulations passed, better transparency, but now we're also beginning to see some integration, some deals that are coming our way that might be more climate or energy related. So that's been an emerging topic for us, but ESG really has been a risk and opportunity lens, and in the last 10 years, I would say it's been more of a risk lens.
One of the examples you recently gave, I think when talking maybe to your board, was the CalPERS looked, for example, at a bunch of its real estate investments to judge how much was coastal, how much of that was potentially threatened. What does that mean? I mean, does that mean you divest things? What does that actually mean?
No, we're not divesting from really anything right now, and that might be a topic we want to talk about, but we really wanted to understand the longer term risks. Some of these assets have been in the portfolio for quite some time. Most of our commercial real estate is urban and coastal. And so we need to make sure that the valuations coming in on those properties accurately reflect what might happen over time. We're a long-term investor. We're invested in these markets for 20, 30, 40, 50 years, and we're holding these assets for that same time frame. So the valuations as they're coming in, if we see a mismatch in what we're seeing in our own risk analysis to what the valuations are coming in, we're going to have a lot of questions about that. We have to price that appropriately within the portfolio. So it's just again, through that risk lens, understanding where we may have upcoming risks that are not priced.
How do you track ESG? And I guess because it's a strange acronym because the three things don't necessarily have anything to do with one another, but they all get lumped together. So, I mean, I guess from a real pragmatic brass tack standpoint, how do you actually track it? I mean, is there a piece of software used? How do you determine that? And is there a score when you look at your investments? This has a 90, this has an 80?
Yeah. So there really isn't a common definition of ESG. I think you can talk to 10 different investors and come up with 10 different definitions. But for us, it's really understanding on the E side. It is the transparency around greenhouse gas emissions, around just energy transition. On the S, it's really around human capital practices within a public company or a private company. And then the G is really the governance around the board. So measurements have been difficult because the data has been quite elusive. Trying to get the markets and the issuers to provide the data that we need to make that assessment has been a bit challenging here in the US. Now, internationally, we're seeing that happen at a faster pace than what we're seeing it here in the US. But the SEC, as you know, is under challenge for promulgating some rules around transparency. But until we get the data, it's very difficult to measure.
You've said that you believe a lot of political blowback against ESG investing has been a misunderstanding of ESG. Isn't it possible they actually do understand and they just don't like it?
It's always possible, right? It's always possible. Policymakers have an agenda that might be different than the agenda of an investor like Calpers. And when some of that money is being poured into those policymakers' campaigns from the oil and gas industry, as one example, that does create a mismatch between a policymaker and an investor like Calpers. So, our approach really has been explain what we're doing, the why of what we're doing, and really reinforcing that the fact that we're looking at this is that we pay 2 million members a retirement benefit for their lifetime, and that's all that matters.
You say that's all that matters. So if you had an investment opportunity that, for lack of a better term, failed your ESG metrics and didn't burn them to the ground, but you thought it was a good investment from pure dollars and cents, you make the investment?
Yes.
Yeah.
It's the difference between that values, so we all have our personal values in the way that we invest our own portfolios. But when you bring your personal values in as a fiduciary of a trust fund, $440 billion as of June, or as of March, you have to set those aside a bit and understand whether that value, that personal value you have, actually creates value for the 2 million beneficiaries. So if we find an opportunity that may fail a few of our due diligence on climate, it doesn't mean we'd walk away from that deal today. We would be a very active voice on how they're going to transition that asset into something that might be cleaner long term.
What does it mean to be an active voice? So you're a shareholder, you're not a control shareholder, most likely of this company, probably very small. Yeah. How loud do you feel you can be? You're obviously not an activist investor at least in that traditional sense. How do you get your voice heard? Is it simple? How do you do that? Mm-hmm.
Well, I think part of it is being a respected investor by these companies. And so when we make a phone call, whether that's a private phone call, and we do a lot of private engagement, that they actually listen to what we're requesting. So whether that is data around scope 1, scope 2 emissions or capital expenditures that they're planning on 2030, 2035, we're actually getting a pretty warm reception to those questions and actually getting answers that we appreciate and like. But we have proxy, proxy season, we can make our voice heard with a number of other investors. But I think you introduced this as Calpers being the largest in the US public pension plan. I think being the largest actually amplifies your voice. And so we can use channels that may not be available to smaller investment funds.
So let me actually ask you about that. There's a bill right now before the state Senate that would require Calpers and CalSTRS, the teachers' pension fund here in the state, to stop investing in fossil fuel companies, specifically the 200 largest publicly traded fossil fuel companies, and eventually divest any existing investments. You're opposed to that. Why?
I am opposed to that. Our board is opposed to that. They supported...
Except one member. You have one.
Well, we had one. Two, who supported the staff recommendation, which was to stay in. So our plan on getting net zero by 2050 isn't to shed the assets. Because we think that we have these relationships, because we think we have an active voice that actually matters to these companies, we think staying in is the right answer today. But on that path to net zero, there may come a time where we don't believe that the company is standing up to what they've told us. So that might be a time that we walk away from a company, but walking away from a sector when you know the energy companies are going to figure this out over time. It's just trying to figure out the timeline by which this will happen.
Do you feel in your position, I guess you could say for the Calpers board position, like you're in a strange spot with no friends when it comes to these issues because you're pro ESG very loudly and so you get hit from the right. You're against this bill, which is obviously being pushed in California by the left. You don't seem to have a friend anywhere to run to on any of this.
Mm-mm. No, the friends really are the beneficiaries, right? They're the beneficiaries of the system that we feel that, we're a 70% funded system today. That really limits your opportunity set. So back to the question of would we invest in something that may not meet all of our ESG standards? The reason for that is, one, we have a fiduciary duty to do that, but two, we're only 70% funded as a pension fund. And we're also looking at rising employer contribution rates, which is really quite threatening to a defined benefit plan. So SB 252, yeah, we're not making friends on either side of this issue, but that's probably okay. If you're making both sides equally unhappy, you're probably somewhere on the right track.
Would you like to make a prediction? What's going to happen in the Senate with this bill?
I could.
I think you should.
I think. All right. I think it's going to pass. That would be my prediction, is that it will pass. And the reason I say that is there is language in this bill that basically puts a caveat that the board of Calpers and CalSTRS, the boards, do not have to divest from these assets if it is against their fiduciary duty. And so the board has already stated very clearly that this is a violation of their fiduciary duty. And so my belief is because that caveat is in there, there's really nothing to lose with passing the bill.
I'm curious though, you made the comment that you think that there's a value to staying in these companies because you can, as you said, you can get disclosures, but you can maybe have an influence on them. Mm-hmm. I mean, wouldn't the greatest influence be to walk away and say you can't have our money anymore, and to be loud? Because Calpers has often said ever since I've been covering stuff for 20 years that people don't blindly follow Calpers, but when Calpers speaks, people listen, and sometimes people do follow your path.
Yeah, frankly, I think many of the companies would be relieved if we walked away. And so we don't believe that that's the right approach for us today. We think that on the public equity side, we stay in. We are divested from coal, by the way. So we have made divestment decisions in the past, but there's been a period of time where that has not occurred, which is the right thing for now. But then on the private equity side or the alternative side, we're actually finding opportunities to invest in cleaner energy or energy tech or climate tech.
Can I ask about that? I mean, do you feel you came in at this point 7 years ago, I guess, into Calpers? Is that right?
2016.
2016. Mm-hmm. Calpers before you, particularly kind of in the late aughts, had a very bad run of it, particularly investing in venture capital funds, but investing in clean tech projects and companies. Did it take a while, for the institution to kind of get over the PTSD of that to start investing again?
Yeah, I think when you're a long-term investor and you're worried about being able to pay those benefits, that's what keeps you up at night. I think any kind of severe market dislocation does have that ripple effect of do I really want to take this risk on again? But the opportunity set does change over market cycles, so we are finding some really interesting opportunities in venture capital, fairly small for us right now on the private equity side. Hedge funds, the size of Calpers, the fees within some of the hedge fund structures, likely not there yet, but everything is on the table right now. Everything is on the table.
Let me ask about the last part of ESG, which is governance. Mm-hmm. Particularly when you are investing in, say, a private equity fund or in a hedge fund or in a venture capital fund. How do you apply the G to that? And I think, for example, you're in a bunch of funds, so these are very small parts because it's indirect, but you're in a bunch of funds that were in FTX, for example. There was no governance there, but you invested in their funds. Mm-hmm. I mean, does that become something that's a red line? You don't invest in the next fund because of that?
No, I think private equity is a bit different. I think we all as limited partners know that when you sign on to private equity, you really have limited governance rights, which is why we are very supportive of ILPA as one example, because that's the LP community coming together to have the same standards for a GP. So that the GPs can't LP shop.
But if a GP then invests in a company like FTX, which basically has no CFO and no board and clearly no controls, doesn't that become we don't invest in you again? Or do we not?
It could. Yeah, I mean, it would likely fail our due diligence. And we have funds where we've said no to. We've said no to some of our primary high conviction GPs based on some due diligence or based on some underwriting that we've done internally. Speaking
of private equity, there was talk several years ago that Calpers, which has a large, not large by Calpers standards, but large by other pension funds and other institutional investors, a large private equity portfolio, that you were interested in outsourcing it to maybe BlackRock or somebody else, putting that out for bids. It didn't ultimately happen. Mm-hmm. Why didn't it happen, and could it happen?
Mm-hmm. Well, I think that it was a fairly new structure that was highly misunderstood. Some of it would have, they were called the pillars of private equity, and some of that would have been, outsourced over to say like a BlackRock, although there were more than, BlackRock certainly bidding on it. But part of it was a reflection of the fact that we're in Sacramento trying to get high talent, high skill set private equity investors to move to Sacramento and then take the compensation that we offer at Calpers. That was one of our challenges. And I think we fixed some of those structural issues. Our board just approved it.
Did you move from Sacramento?
We have not moved from Sacramento, but we've improved some of the compensation structures that the board just approved it last month. And so, we may open other offices if we believe we, would better, be served with boots on the ground.
So you could really follow the model that we've seen from some public pensions in other countries that, have opened an office, say, in San Francisco. You could see there being a Calpers office in wherever. Actually, where? Where would there be a Calpers office?
I could see one in San Francisco. As an example, to help with talent acquisition.
But that's within state that you guys, could
New York, Asia, somewhere.
Yeah. Mm-hmm. How is that something that's truly on the board, that you guys are looking at real estate and looking at people?
Yes.
It's interesting. I wondered, the other piece of that is Calpers a long time ago during the dot-com boom had a large venture capital fund portfolio. Didn't do very well, and then it did very badly actually, and then ultimately basically stopped investing in venture altogether. In part also because there was an argument to be made that Calpers needed these large minimum check sizes, and most venture funds, if you're raising a $200 million venture fund, it didn't make sense.
Yep.
You've made some small entrees back in, mostly through fund of funds. Mm-hmm. Does Calpers want to be back in actual venture capital? Mm-hmm.
No, we are back in it. We're very selective, and part of being selective is making sure that we have the right people making those selections. And so we've closed on venture deals. We like late stage venture, of course, but frankly, we missed out on all of the Silicon Valley growth. We missed out on that entire time frame. Whereas our peers really were able to take advantage of the great returns that came out of our own backyard, and we missed out. So we have to look at those opportunities. And again, back to everything is on the table right now. We have a new CIO.
Can I ask though quickly? Do you worry you've come in too late? In other words, Calpers came in a little bit late originally and paid the price, then it left. When it was gone, that's when the good returns were made. Now you're coming back in, and this might be another time when you're now coming in when the returns are about to be bad again.
Well, here's the problem. You can't be shy about entry, right? So you have to enter and stay, and enter and deal with all of the market turmoil that may happen. What happened in private equity as well as venture, people got shy, lost some courage, exited at exactly the wrong time, or did not keep the capital pacing. Right, so consistent capital pacing, really important both to private equity, but as well as to VC. And we have this chart that we're showing where we were completely out of the private equity markets for about 15 years, and then the impact that had on returns.
Well, one of the last things, just about kind of programs, things you're doing, there was also talk, almost around the same time as the BlackRock and outsourcing, the Calpers, that you wanted to launch a kind of a direct investing program, kind of very similar to what we've seen from some of the Canadian pension funds. I think, Nicole, you made a comment that it's kind of a 10-year process if you're going to do this, or maybe you said it. Are you starting that? Because if it's a 10-year process, it's a 10-year process.
Right. No, we are starting it. I think we're getting ready to share with the board the 2030 plan for the investment office, and we're seeing a little quickened pace on the types of direct opportunities that may be coming into Calpers. You look at the type of talent that Nicole, she did come out of the Canadian plans, that she's been able to acquire since her time here. She's about 1 year into the job. And you can see the direction of Calpers. If you look at the talent, you look at the team we're hiring, you can see the direction we're taking.
So, I mean, could we see Calpers become the majority owner of a company? Calpers buys Company X? That's coming soon?
Soon might be
time. Are we talking a year, 2 years, 3 years?
I would say within the next 2 to 3 years.
Next 2 to 3 years. I'm wondering, how do you think that there's been a bunch of talk, and we've kind of been waiting, that the White House is that Biden is at some point going to have an executive order which limits U.S. outbound investment into certain Chinese sorts of companies, sorts of technologies. This could also impact funds. Calpers has investments in a bunch of funds, Sequoia China Fund, for example. Do you believe that, at least the way we know the broad strokes of this, it would block, for example, investments in AI, certain chip making, et cetera? Is that a good policy?
I think it's always challenging to count China out, especially if you're thinking about growth on a portfolio that is expecting to get 6.8. We put in an emerging market debt strategy. We did not put China in that strategy at the time. So we're pretty underweight China relative to our peers. But remember, it wasn't that long ago that we had our chief investment officer at the time, who actually was born in China, went through a very difficult attack on allegations that he was misdirecting funds, which was completely nonsense. But that took a real toll on that individual. So China will always be a political issue. But from an investment standpoint, it's hard to discount China.
But so I'm wondering though, I mean, do you hear what's possibly coming and think that, oh, we're about to have to divest a bunch of, if this order comes down, we have a bunch of stuff that's probably going to be in violation of this order?
We don't have a bunch of stuff. Like I said,
you have some stuff?
We have some stuff. We're underweight. We think that exiting that would not be a problem for Calpers if that ended up being the federal requirement. But when this happened, 4 or 5 years ago, China was not put on OFAC, and that's what the investors follow. So foreign asset control, we follow every regulation, every rule therefore. But we're underweight. I don't think it would be difficult if we had to exit. But supply chain issues, I think you have to really evaluate what the supply chain disruptions would be if you count China out.
You talked about how fulfilling the fiduciary duty to the pensioners is your primary job, and you guys are 71% right now funded. Do you feel your job is more financial or more political?
Depends on the day. It really is a combination of the two. You're absolutely right. Political in the sense that you want to put up a really good, I think part of my job is, I call it boundary patrol, right? So putting up a good front around information and communication and context and accessibility to the decisions that we're making and why we're making them. And then the financial side is really, that's with Nicole, that's with the team, but really understanding what we're doing on the investing and whether we're going to get that value from the value creation. So I would say, it's probably 60-70% political.
Final question for you. You came from Washington State Investment Board. Obviously, in terms of size, smaller than Calpers was. But leaving the dollars aside, What was the biggest difference between doing a similar job, not CIO, but a similar job at WSIB to Calpers?
Yeah, so I was the chair of the board at Washington State Investment Board. And, I think the difference is there is a complete alignment of interests with the trustees on that board around the importance of private equity as the primary. I think, they had 30% of the portfolio was in private equity, and they had been in private equity from 1981, 1982, right at the inception of, of that asset class. Whereas Calpers has had its stops and starts, and there's been a real cost and a price to those stops and starts. So I think there's just been a more aligned culture and value set when I was at the Washington State Investment Board, and then Calpers being the largest. We want our voice to matter. The Washington State Investment Board, their voice matters, but their voice mattered as an investor, not someone trying to change the world dynamic.
Marcie, thank you so much for coming down from Sacramento.
Yeah, thank you.